Hello again, this is Dwayne Malone with part 2 of the ECAM market update for the market close as of the 23rd of July 2010. Now that we've looked at the more intermediate to long-term charts, I want to have a bit of a peek at the short-term charts. I've called up the daily chart of the S&P 500 index going back for the last 6 months. And as you can see, we actually topped out in the third week of April. And at that point, we set up a series of lower lows and lower highs, which created this downtrending channel. You can see that it was very well defined. And I've got these two dotted lines defining the downtrending channel. Now, the key thing to note on this is that we broke below the 50-day moving average way back here, which you can't see because it's hidden by this little indicator. But we broke below it here, and at that point we actually came up to challenge it once, twice, 3 times, and failed at the 50-day moving average. And on Thursday, we actually broke for the first time in about 3 months above the 50-day moving average. Up until say 2 days ago, that was very bearish, but now, because we've broken above the 50 for the first time, that potentially could be a bullish indication. What I'd like to see in conjunction with that is my technical indicators switching positive on the daily charts. The RSI is now above 50. The stochastic midpoint, the Bollinger Band midpoint, has now been broken to the upside. The stochastic is above 50. The MACD has crossed over positive. The ADX was a little late getting to the game, but you see the DI line crossed above the DI, the positive crossed above the negative just today. The force index has been kind of, wishy-washy up and down, but it is now back into positive as of today. And the on-balance volume, which is what I look at on a daily chart versus the 20-day moving average, has moved back to positive. So in the short term, it's actually looking pretty positive on the S&P 500 index. Now, I'm going to point out on another chart an area of congestion, but you can basically see it here from basically about 1060 up to 1100. I'll present a clearer chart here on the next chart, but you can see this is an area of support and resistance we've been in now for about almost 3 months. So I've been very reticent to do anything because we have been stuck in this trading range. We came a little bit outside of it on the upside here, a little bit on the downside here, but now we're back into the same range. So essentially what's happened is the market is churning. Those that are trying to trade the market up and down on a daily or swing weekly basis have basically been losing their shirts. They've been losing money. And this is what the market sometimes does. So sometimes the best thing to do when you're in this type of environment is to basically sit on your hands and do nothing. The next chart I want to show before I go on to the shorter term charts is the point and figure chart. The point and figure chart I love to use because it cuts out a lot of the noise and it gives you a really good indication as to where the overall general intermediate market direction is. Essentially the way this works is a series of O's and X's, as you can see, and the prevailing trend is defined by where the last series of X's or O's broke above the last series of X's or O's. So for instance, coming back way back here, make it simple. Essentially, we were in a downtrend, you can see down here, and then sometime in 2009, the actual dates on the chart are not really as important because it's strictly based upon price, and it's not based upon time, which is really interesting. So it's a different type of chart, but you can see that we came up here with a series of X's, which is a rising market, and when this X hit here at, I guess it would be 935, was the point at which this went from a bearish configuration to bullish, and there would have been a buy signal generated there. Now, as long as this series continues, and you've got a series of higher X's and lower lows, you're in a bull market, all right? And it rose all the way up, and the first indication we had a bear market was when it broke down here, and the first O that occurred at 1060, and that occurred back in just about April, I think it was, of 2010. And these little numbers here, you can see 3, 2, 1, whatever it is. Okay, so 1 is January, 2 is February, 3 is March, 4 is April, and this is 5. So is May. So this actually would have occurred in May that actually broke below this level. So I stand corrected. It was May. And at that point, we set up what would have been a bearish configuration. It meandered along, still bearish, still bearish, still bearish. And then we had a fall signal here in June through 1110 level, which actually took us up to a bullish configuration. All right, so we were bullish there. But then it was reversed again through 1040 in, once again, towards late June. And after that, it's been basically bearish ever since. Now, you can see, once again, we've just, as of Friday, done another bullish configuration change. So it has been meandering around the last little bit, but you can really see where the defined bull and bear levels are in the last, say, 3 or 4 months. You can see this level here of 1130, which is the highest X there, and the low is 1020. So essentially, this is our trading range, our large trading range at this point, okay? So we're stuck between this range, really, and until this gets resolved to the upside or the downside, it's a bit on the neutral side, okay? However, we do have, as I said, a buy signal as of Friday. Now, along with this, I have the volumetric levels here on the left-hand side of the chart. What these are areas of support and resistance. Basically, they are buy and sell volume levels along the various price levels. Okay, nothing to do with time, just to do with price. And you can see that this level here of 1090 is a very, very important level of support and resistance. It's got both. It's got buys and it's got sells, but you can see it's got a very large bar here. So that's a very large level of support and resistance. Above that, 1100 is quite strong, and then 1010. And you see above 1010, really there's very little in the way of chart volumetric resistance or support. So if we can get above about 1010, the market has a good chance of sort of free floating to the upside. If it goes the other way, you can see here there, 1080 doesn't have very much, but then 1070 and 1060 are quite large. So if it can actually get below 1060 on the downside now, it would have a very good chance of actually continuing to the downside. So, 1060 looks to me on the volumetrics as being quite an important level. And on the upside, we're looking at about 1100 to 1110 as being the important levels. The last chart I want to show you is the 30-minute chart of the S&P 500 index. Once again, we've gone from our 40,000-foot sort of top-down view of the monthly, down through the weekly, down through the daily, and now we're into the really nitty-gritty, minute-by-minute stuff. We're in the 30-minute chart, and I wanted to point out what I'm looking at on the very short term. My last update before these video blogs, my last written update, I mentioned that we were in a bear market configuration, but we were very, very oversold, and I was looking for a short-term bounce. Well, that bounce occurred in the very early parts of June, okay, where we had this little level here where we hit 1010, and I knew we were oversold, so I knew we were going to get some sort of a bounce. That's indicated by the MACD being very, very low. I mean, we're down to minus 10. That's a very, very low level, along with a full stochastic on the 30 minutes being way, way below 20. So I knew that we were oversold, and at some point we were going to get a bounce. Now, where it was, I didn't know, but I needed to wait to decide what I was going to do based upon the fact that we were oversold. So I waited and waited, and then we got our little bounce. And then I sort of said, okay, well, we got the bounce. Now we got our crossing of these moving averages, all right, which is once again the 1334 EMAs, but now on a 30-minute chart. So now I said, okay, well, now we're into a bit of a short-term rising market. So I'm going to ride this thing up. I'm not going to switch my Provident Fund. I'll wait to see what happens on the upside. I waited and waited and waited. We got into this trading range between 1060 and 1100, 1099, 1100, all right. It remained that way from the 8th of July up until yesterday. And yesterday, we actually broke for the first time above 1100. So now, this is the range at which I said, okay, well, if it does break below 1060, I would have sold into my Provident Fund. Now, because it's broken on the upside, I'm going to wait. I'm going to use this 1100 level as my support level. I'm going to watch and see what happens. Hopefully, it'll stay above 1100. If it does, I'll use that as my base. If it can base there for a few days, great. In which case, I will use it as my base, sell if it breaks below. But if it doesn't, and it breaks below 1060, I'll use that as my sell level. So that's what I'm looking at. This is Dwayne Malone with the ECAM blog site.